Hi, everyone. Hi, Rohit. Welcome to Venture with Grace today.
Hey,
Uh,
Grace. Thanks for having me.
Amazing. Okay, so to give the audience a little bit background, Rohit is the head of corporate development at Block. Prior to that, he was the head of capital markets at Juxtapose and former VP and head of corporate development at WeWork, corporate development at Twilio, and Samsung. To start off the show, why don't we let you to talk to the audience about how you kind of got into this role from studying law to you have like such a great track record in so many different corp dev positions, so I would love to just like get an overview of like your career, although we have talked about this, but I want the audience to know. But
Sure. Yeah, we'll share it with whoever else is interested. Yeah, look, thanks, Grace, again for having me. And you hit it right. Like, I have a lot of formal M&A training within in both investment banking and corporate law. I started my career in tech banking, which is a little bit backwards. Most folks that do both law and banking usually do the law thing first and then banking. But I had basically started in at Jefferies, which and the group was the former Broadview Group, which had a really big rise through the internet bubble back in the early aughts and late '90s, and then became part of Jefferies later. And so I was very careful about the group I chose. I was interested in technology. At that time, the SaaS businesses were just starting to really get their footing, moving from on-prem software to SaaS models. Digital media was starting to become a real thing and disruptive to traditional media. And so ad tech was a big area I covered. And Jeffrey specifically worked with a lot of growth stage companies and startups, frankly, which most investment
Mhm,
banks don't, especially at
mhm,
that time. And so I really loved working with startups. And so that was kind of the start of it all. And, M&A was kind of just really a tool, a vehicle to be in that conversation with founders and investors. And I always knew I was going to go to law school, and so I did that as well. And when I was a corporate lawyer, I focused on M&A and emerging companies work, and so
mhm,
worked with a lot of actually. You mentioned I ran corporate development at WeWork, but I actually also advised folks in their Series C investment into WeWork as
mhm,
well. And so I was working with a lot of clients on both on the buy side and on the startup side, like Novacure was another one. And I just really enjoyed that aspect of it. And so like it became
mhm,
clear to me like the technical aspects of M&A are important table stakes, but it wasn't what really got me up out of bed. And so
mhm,
that quickly had me thinking about what's next, right? I wanted to get deeper into working with technology companies, operating businesses, and the paths I was really thinking through were corporate development and business development, and
mhm,
through a lot of honestly just like networking and talking to people, because it's not always the most obvious thing for a lawyer, formerly trained banker, to just jump into corporate development, especially at that time.
mhm,
It's but just kind of having conversations, meeting people, and then ultimately getting a break to go move from the East Coast to Silicon Valley and go work for
mhm,
Samsung's nascent corp dev team at that time.
mhm,
Corporate development usually do need that M&A background, but it wasn't that there was a non-obvious move for a lawyer from the East Coast. It's becoming more commonplace for both lawyers, consultants, bankers, former venture capitalists to move into corporate development. In fact, it's becoming kind of the prerequisite, but it wasn't always obvious for lawyers to make that jump. But today, I would say 30 to 40 to 50% of the corporate development professionals out there are probably formerly trained lawyers, in addition to formerly trained bankers. So, that's kind of what brought me through this journey. And then it's been hard to leave. Like corporate development is such a fun job, right?
mhm,
You're getting to get the best of both worlds sometimes, right? You're working at these really, if you chose the right company, something that's mission driven, something that's disruptive in its own right, you're getting to work on that from an operational perspective, kind of figuring out what the right product direction and strategies are, working very closely with the C-suite, kind of getting to fly both at that bottoms up, kind of getting to do both the bottoms up work with the product leads and GMs, but then also getting that top down view, while also you still get to have your, eat your cake and have it too, because like you're still getting to spend time with all these
mhm,
amazing founders and startups and learning about new technologies on the regular,
mhm,
not too different from a venture capitalist. So you kind of get the
mhm,
best of both worlds, but you're also not chasing deal flow as much. Like the things
mhm,
come to you if you've chosen the right platform. And I've been fortunate enough to have Worked at some really, awesome, iconic companies. Twilio, obviously WeWork had its issues, but it was definitely a high flyer for a while, and obviously now Block. So you don't have to chase the deal flow like an investor. You get a lot of inbound. You also get this amazing edge in terms of the internal expertise you've built in your industry with the product teams and GMs you work with. And then you still get to talk to all these awesome founders and startups. So it's really like an amazing intersection of a lot of different
Mhm.
things. And it's, I don't know, I would be hard pressed to find something more interesting at least in the near term.
I'm so jealous of you right now because I feel like it's such a good position to be in. Like you can, like you said, like you actually have daily conversation or like just frequent conversation with like the C-suite executives to, learn about an industry, and then you guys probably seeing a lot of things that like a lot of the new tech trends or like a lot of new finance trend, um, in house because of like there's actually you guys have a pretty good like company as the base, so you get a lot of like the more technical information, and then basically um you're like in a great position to have the domain expertise and surrounded yourself with the ecosystem, as well as like getting the insights from like these really amazing like entrepreneurs or like C levels. And I wonder like can you walk us through your day as like the corp dev at Block, and what is it like? Do you go through, I guess, like what is like the overall benchmark you would set for yourself every month? So do you have to, let's say, do 5 deals per quarter, or like what does a benchmark look like, and how does a deal happen typically? We could go from, there's the aqua hire, there is the, for example, the technology hire, for example, like there's a new trend, and if you build something from scratch, it's going to take 45 years, but if you just acquire a company or the technology, it's a lot faster, to the overall distribution or like new client or new customer like acquisition. I wonder like, when you're thinking about all of these different type of acquisitions, like how does your day or your work life structured with a lot of these different types and goals?
Yeah,
Sorry,
no,
this is such a
yeah,
big question.
yeah, it's a lot of things. So I'll just answer some of it, and then you can direct me whatever you think is
Okay.
interesting. Yeah, no, it's a good question. I don't I and I think it depends on each corporate development function, but I don't spend a ton of time thinking about funnel pipeline generation numbers, at least like quantity instead of quality, as like a
Mhm.
true metric. Like we measure it for sure. I want to know how many NDAs we've signed, how many companies we've had a conversation with. I want to benchmark us, just take a look at how we did year over year, make sure we're not being passive and waiting for things to come inbound. Like I do measure it and we do look at it. And I have throughout my career, but I don't think like ultimately that's going to be the measure by which you can tell whether you've been successful within the corporate development function. And for sure, the number of deals closed is not one of those metrics. It actually, I would argue, creates a weird incentive where you want to close deals even if they're not necessarily good, because unlike an investor, you don't have that long-term measurement on financial return. There are internal accountability measures, but once you've acquired a business as a corp dev professional, you are ultimately integrating it into the business. And so a lot of the KPIs and metrics that you're tracking for business success post acquisition aren't really owned by corp dev. They're owned by people who sponsored the deal within the business. And
Mhm.
so I don't I don't really think about the number of deals closed as that interesting. I think the funnel and the pipeline generation is important, just from like making sure you're not losing your level of status quo activity. But it's not kind of like,
Mhm.
oh, I hope we meet like 5 companies a week. There probably is an average. I can like take a look at our data and see how many companies a week we do meet. It's probably a few a week, but it's not like the team goes out and thinks every day like we have to meet this many companies. And so really what it comes down to, I'd say, and it's different. Now I'm fortunate enough to be the leader of the function versus if you're starting out or kind of midway through your career and more of a deal lead. The things you measure yourself by are different. But looking at it kind of more holistically, I really like the things I care about and try to direct the team towards are what, if we've identified opportunities, like we spend a lot of time working with the businesses, both bottoms up and again from C-suite, top down, identifying areas of opportunity, less about so kind of thematically, right? Thinking about
Mhm.
where are areas that we are ignoring from a organic build perspective, or if we're not ignoring them, we are building, where are gaps in the product portfolio where we really should be thinking about partnering or buying as opposed to building because of the time sensitivity of launching a certain product, because of the resource intensiveness uh, of of trying to build it ourselves, or maybe a lack of competence. It's like a specialized area subject matter that buying would make some more sense. Once we've identified those opportunities, it's really about making sure we have some velocity in terms of
Mhm.
producing strategic landscapes, producing kind of hypotheses about what the best way to go about filling that gap is. Is it partnering? Is it buying? So it's, and I would say like month to month, if I took like a monthly view, there'd probably be, a handful of areas we've identified working closely with, again, the C-suite, product leads, GMs, and then like, how do we actually create a framework for deciding what we want to do about it, whether it's, again, building, buying, partnering. How do we get the business smarter about what opportunities there are out there? Kind of overcoming inertia on this thing, we can build this ourselves, and kind of outlining the benefit of why buying or partnering has value as opposed to taking the year or 2 years to build the thing yourself. And like those strategic write-ups, those landscapes, those kind of build by partner analyses, that's really what I measure us by. Like how many of those,
Mhm.
like there is some quantitative measure to that. Like how many of those do we do this quarter? How many of those did we do this
Mhm.
month? And like those are the big rocks often. And then of
Mhm.
course you're working on live transactions as well. And so that those are a lot more easily measurable. You set a timeline of when, with specific milestones, like when you're signing a term sheet, when you're signing the definitive documents. Did day
Mhm.
one go well? After you've acquired the business, there's integration milestones, right? You've identified a set of strategic objectives for the acquisition, and
Mhm.
so checking in on a quarterly basis. Are we hitting those metrics? What are the blockers? Are there things we need to do to better integrate with our foundational teams, with those businesses, to make sure that we aren't potentially losing an opportunity to realize synergies? So like live deals we're integrating, that's a lot easier to measure and set your roadmap around. When we're working on the kind of funnel generation side, that's often the tougher piece, because I don't think it's like a great measure to just see how many companies you've met. It's really about, okay, now you've identified things, right, with the businesses, and reevaluating whether the things we're spending time on are the right ones, at least on a quarterly cadence. And what are you doing to further the thinking on it? Like, again, the strategic write-ups and things like that. One more thing I think you asked, and I'll try to answer, and then happy to take it any direction. Uh, how do we actually meet companies, and like how do we ultimately evaluate opportunities? Like, yeah, we're lucky. Like I said, we're lucky enough that maybe half of the opportunities, if not a little bit more, of what we see is really just inbound from investors, from
Mhm.
bankers, and even inbound from other teams within the business, right? Like people have
Mhm.
friends who work in
Mhm.
the startup world, right? And they want to introduce them to you. And then there's like the proactive piece, right? And the proactive piece again
Mhm.
comes back to, we've identified this need in our stack. Corp Dev did like an analysis and kind of a landscape review. There's maybe 100 companies that do this. Of the 100 companies, there's like 10 to 15 that seem interesting and hit our criteria around what we're looking for in terms of buying, in terms of maximum check size, in terms of
Mhm.
like distribution, geographic location, headcount, etc. And then we can go proactively talk to those companies once we've identified them. And sometimes it's cold outreach, sometimes it's warm out intro, and I think again we're lucky, unlike maybe a lot of investors, where folks want to talk to. If you're at the right company, folks want to talk to you, and so um, yeah, those outreaches are pretty streamlined.
Totally. I wonder, um, you know, I wonder, like, can you walk us through a particular deal that you've done that's, how do you identify this? And then what is like the corporate like value into like acquiring this company or like investing in the company and to eventually, like what kind of goal is Block trying to achieve? So for example, you guys acquired a music financial app that's called like Hi-Fi or Hi-Fi. So I wonder, we don't have to use this particular company. I wonder, like, what's your thinking framework behind like one of the company that you have, um, one of the deals that you have done.
Yeah, I won't choose that one just because it's so recent and we're still kind of in the middle of a lot of things there. I think we closed that one
Mhm,
just a few months ago, so won't pick that one. We did acquire a business called GoParrot a while
mhm,
back, and it's for the Square business. We acquired it. It's a small kind of tuck-in acquisition, and uh, you know, found it. It's a business that's located in maybe an unlikely place in Moldova, actually. But it was
mhm,
very much that deal is very much an opportunity where we identified a need within our business, like looking internally before you look externally on what are you trying to accomplish. So what
mhm,
we recognized is as we were spending more time with our food and beverage and restaurant vertical within Square, there
mhm,
were a number of things, feature sets that we're missing as we try to move more upmarket, right? Square services a smaller seller, a smaller merchant. Typically,
mhm,
there's definitely exceptions to that, but largely we skew on the longer tail of the micro
mhm,
merchant, kind of smaller SMBs.
mhm,
Within the restaurant space, right? Like multi-unit ownership, a restaurateur that owns multi-units or franchises have their own set of needs. And so recognizing that to move up market, this is actually a very easy way to do this. To graduate, not easy, but a very credible way to graduate with our existing customers as they go into multi-site, and also to go after a segment that we service already, but not with a franchise portfolio view of how the restaurants are doing. Uh, it was kind of obvious, and the idea, and like we have this platform, right, and we have a vertically targeted part of that platform, and like having recognized that there's just gaps in that, but we have a successful go to market. We have like product market fit for sure. It becomes easier to then go look and say, hey, are there things I can actually just plug in to some of these gaps? It's
mhm,
different when you're starting to just quickly, like as we're thinking through these opportunities, it becomes tougher and more complex when you're looking to extend the platform, you're trying to launch a new business line. But in this instance, and this is usually a lot of time where we spend our time, is like let's play to our strengths, right? We have this platform, we know how to go to market, we have a customer base, we have a sense of where we want to move next in terms of the next customer population. And so what are the gaps, and like can we plug that into our platform? And so some of the analysis we do there is
mhm,
what's the integration debt we're going to take on. uh,
mhm,
it's easier to acquire a point solution, to acquire something that's
mhm,
narrow, so you don't have to then spend a ton of time figuring out, do we deprecate their feature, do we deprecate ours? And so that was kind of part of the lens, like trying to find something that helped us move more into that franchise space without having all the other broader feature set for restaurants, because then we have to either sunset something they offer or sunset something we offer, or inherit some new products that are tackling a customer population that we're not ready to address yet.
mhm,
And so, in this instance, like I said, we were trying to move into franchises. It was kind of part of our broader go-to-market strategy. And so, scan the world for companies that are servicing them. And again, great thing about corp dev is we can play to our strengths. So we have a partnerships function that sits separate from us, and they have a great sense of different partners that help us extend our platform, that our end users, our end customers are partnering with to make the Square solution work better for them. And so, GoParrot was a partner, and we kind of made a short list of different companies we wanted to evaluate. And it's a lot about evaluating cultural fit. Obviously, the price has to seem reasonable relative to their underlying financials. Strong team. Are they going to come in and plug into our culture and like help us develop this? Help us navigate the integration challenges, or is there going
mhm,
to be organ rejection? And that's the work you do up front. And in the negotiation, as you do price discovery, you have a
mhm,
certain expectation about what you're going to pay, and oftentimes you
mhm,
don't see eye to eye. And so there's really honestly a mutual if you do it well, it's a mutual conversation about
mhm,
okay, you see this is your price, why, like, like we don't see eye to eye there. We think this would be the right price, and challenging each other's assumptions. And in that instance, yeah, we went back to the drawing board and kind of rethought some of our assumptions together, actually, and then we're able to decide to move forward on that transaction. And so, um, each deal is different, but the ones that I like to spend a lot of time on are the ones where we understand our strengths as a platform. And this isn't just at Block, this kind of broadly, as I think back to most of the companies I've worked in. You think
Mhm.
about our strengths as a platform and what are the types of gaps that we can really plug and play a solution into very quickly. And again, point solutions are just easier.
Mhm.
Another quick example on that is, when I was at WeWork, we acquired a workplace management solution called Team, and it was about room booking and room reservations and visitor management. There are much more complex enterprise office software products out there. But knowing where we were in our journey of building workplace management software, buying a point solution and building on top of it, off our existing software stack, was going to be a lot faster and increase their chance of success. So you don't have to take on all this integration complexity of, again, what parts of their product do you sunset, what parts of your product do you sunset, how do you consolidate the different stacks you're on? Like, it just
Mhm.
decreases the complexity. And so I love working on those where it's like, hey, we have this amazing platform, we have this great distribution. What can we plug in and get into more customers' hands faster?
Totally. I wonder when you are thinking about in terms of like for example, let's say GoParrot, like how like you mentioned like this is like a so I guess like when you spot this deal to um like doing analysis to like eventually incorporate them into your company, how long does it take, and then how much time is it like upfront to do the research, and then how many times do you have to chat with the founder to figure out if there's a fit, and like what is the conversation involved? Is that like the CEO have to show up, or like is that just the corp dev team, or with the startup? And I'm sure it's depending on the size of the startup or like the scale of the acquisition, right? I guess like how does the process go? And then, previously we chat about, founders should like there's a lot of things that founders should do to do their due diligence and then before they're selling a company, right? What are some tips that you could give founders in terms of uh, you know, if they're the company that's being acquired by a company?
Yeah, this is an awesome question. I was just last night speaking with some founders who have talked about their trauma going through the M&A process.
Mhm.
And um, I don't want anything I do in my life, whether professionally or personally, to be characterized as trauma. And so, I mean, sometimes it is, but I don't want it to be, right? And so I do spend a lot of time thinking about this question. Um, I think everybody wants to close a deal quickly. That's like the first operating assumption that both sides are working through, right? As a buyer, it becomes a distraction to the business because let me take a half a step back. So in corp dev, oftentimes I'm working with a deal sponsor, right? It's either
Mhm.
the GM of a business, it might be your CEO as well, depending on this, like you said, the scale of the acquisition. On like a smaller acquisition, our company CEO is probably not spending a ton of time on it, other than to just understand whether the rationale makes sense. Um, so on those smaller ones, especially, yeah, you have like a GM, you have somebody who's a deal sponsor working with you hand in hand. And if the longer the deal takes to get done, the longer it takes for the deal sponsor to meet the objectives, right? Like the acquisition
Mhm.
is hopefully furthering some very concrete purpose, right? Helping them achieve
Mhm.
some milestones, and delays
Mhm.
that. I think more importantly, what people don't understand from the buyer side and deal sponsors often don't totally get, it's like a second job, right? Like if we're doing our job well as corp dev, like we don't have to involve the deal sponsor more than a couple times a week, check-ins. But at some point, the deal evaluation shifts to integration planning. And for integration planning, for sure, like, within corp dev, we have an integration function as well. And a great group of folks that work cross-functionally and project manage us through the process and post acquisition as well. But ultimately, you're integrating it into this deal sponsor's business, and so the deal sponsor has to get very involved. And so you're trying to move fast. And as on the founder side, the seller side, you're also trying to move fast because the investors into the seller's business, right? The target's business are now, once they've made the decision, hey, we're selling. they're trying to get this done, right? They're trying to get the mark the book value in their fund and move on to helping and advising the next company, right? Because at that point, the decision's been made. We had this, like, as an investor, you have this hopefully 10-year arc. You're thinking about working with this company, and now, before you hit that 10-year plan, you're selling your business. The investor's like, okay, I'm out too, right? And so they want to move very quickly. And so that's kind of I think everybody starts from there, and everybody's also trying to optimize around price. And I think these two things end up creating a lot of uncertainty and things, and people, and I think side effects and downstream effects that nobody really anticipates through the process. And so, if you've identified, if you've maximized on price to start, maybe from the seller side, as a founder, you don't yet know, right? It's like an interview process. You're getting to know the business that's buying you. If you maximized on price and you didn't like do your reverse diligence on culture and like what my role is going to be at this business as an employee now, right? You went from being a founder to an employee. What is my role going to be there? What's going to happen to my team? What's my compensation package going to be? How am I going to operate? Like when we set milestones and objectives, like who do I report to? How am I held accountable? Will I get resourcing? A lot of times in the beginning, you're working on the deal valuation and maximizing price, and you don't answer all these questions that are really going to impact your life as the founder and the management team being absorbed into this acquirer. That's not going to impact the investors, right? The investors will care about, like, if there's any deferred consideration, like is there any of the purchase price that's going to be paid later? They'll care about that. They'll care about if there's any holdback for breaches of contract, for indemnities purposes, for liabilities that come later. But these other factors that are really going to impact your day-to-day life as the founder, seller, the management team, they sometimes get pushed to later on. And then as it becomes real, right, the process becomes real, because when you're in the process, it's still 50-50 whether something's going to happen at best. And as you get closer to what seems like the finish line on closing, these questions start popping up. And so it becomes complex, because on the buyer side, on our side, we've done this many times, right? And so we tend to assume, okay, you've negotiated what you want to negotiate with us, right? And so you really cared about price. So on these other things, we're going to get what we want. And I think that's where some of this, as I heard characterized as trauma, comes from. It's just a misalignment of expectations. And like, yes, we paid a premium on price. So on these other things, we're going to get what we need. And but that's not how the founder sees it, right? The founder hasn't done this before, or if they've done it once or twice before. And so like, I really try, I hope in these processes that I can be a coach. I still ultimately am, my responsibility is to my company, right? And on the buyer side, right? But you kind of have to coach them early on, and it doesn't always work, because everybody wants to maximize price, everybody wants to get paid. That's definitely part of it. But you're trying to say, this is just one factor, a very big factor in your decision. But let's talk through everything else. Do you like working here? Do you like the mission orientation? Do you like the purpose? Do you think you could see yourself working here for 5 years? Do you want to become a leader at this business? Do you want, you started off with this business hoping to get into the hands of many customers and make some impact in your industry or the world. Do you think you further that purpose more with us or with somebody else? And like having a lot of those kind of soft questions answered early on and baking that into the key terms that you care about is really important. And I think it's missed. And then, I think also recognizing that, yeah, we're all trying to move fast, and I need to get better at this personally. But a lot of times we'll set like a 60, 90-day window to try to get from end to end. But ultimately it takes 2 to make a deal. And I think you can control the diligence, you can control like the financial analysis. Again, the deal evaluation part, you can honestly time box into like 30 days, 45 days, depending on the complexity of the acquisition. But then all the things after, negotiating the rest of the key terms, the integration planning, approvals you might need, licensing approvals you might need, those things can take a long time and are exogenous to the process sometimes. And it's hard to know how to predict how long that'll take. Because even if you've done this many times before, some of those things just remain uncertain. I look at in the world, iRobot and Amazon, right? And they have antitrust going on. I'm sure they thought they can get that deal done in a year, and it's been going on for God knows how long. And so you make your best guess, but that's where sometimes I think the trauma, the frustration comes. And so what I want to try to do better, and I think I've done a decent job of throughout my career, is pulling aside the founder, having a real conversation about like what I think the time will be, how long it'll take, but these are the things, these are the things that can impact that. here are the key terms that I'm going to care about. I hope you feel like you understand those. Trying to, they won't always believe me, but trying to also align expectations of where your investors' interests are, where our interests are, and where yours are. And like, you should know them. I'm not going to help you negotiate your side of the bargain, but at least you should understand that there are these varying incentives as we go through this process, and it's not going to be easy to manage. And so, each process is different, takes a long time. I think managing everybody's expectations, from the deal sponsor, the founder managing the investor and board's expectations on their end. I try to play coach across all of that because I've seen all these dynamics and from both sides. And so that's where I think deals go sideways, is when those expectations are aligned. It's very much the case in smaller acquisitions, actually. If you're working on something of greater scale, where the seller itself also has bankers and advisors and they've done M&A of their own, and you're acquiring that type of business, they understand. You understand that the leverage is kind of similar. Those deals don't have as much of these friction points I just mentioned, but those smaller acquisitions, especially when it's like the selling team's first time going through it, I spend a lot of energy trying to manage those expectations. And I've gone both ways. Last thing I'll say is, like, in the past 5 or 6 years, the market's been really hot. As in, somebody that probably does some investing, you probably know, but from the acquisition side as well. And so some of the things you do, like if everybody's paying a competitive price, is promise a faster deal timeline. You promise a cleaner contract. Things like you'll as a buyer get comfortable with taking on certain risk in the contract that you wouldn't typically do. I think I'm seeing the times shift back a little bit, and it's always ebbing and flowing. And so we're now moving back to a place where we're going to take our time to do diligence. We're going to, the contract's going to look more standard. It's not going to be as founder friendly. And I think it's taking a while for both sides to acclimate to that new reality. I think we're getting there, but call it, I'm making up years, but like 2014 to like early 22 was just kind of a unique time in terms of being running more seller friendly processes. And now I think we're recalibrating a bit. And so also just managing those expectations. And look, sometimes you just won't see eye to eye, and you should revisit it at a different time when expectations about the process, the contract, price are all more aligned.
Totally. I think that's really cool that you mentioned about, like, you kind of like walk us through the process of like how startup are thinking and then how you guys are thinking about these. I think that's really, like, I would never imagine all these like traumatized situation, or like basically like, people align with each other about the expectation on how the deal should be made, or like what they're offering and what everybody's kind of like jobs is. I think that's really, really cool. And I wonder, because of like you guys are acquiring a lot of companies, and then how do you evaluate what should be built in-house and versus what should be bought?
Yeah, I wish I had an even better framework for this, but it's not easy. I would say, like, I kind of, depending on the business need and what we're actually going after, like what is the actual business need and what is the strategy we're trying to further with this build by partner analysis. I kind of create a new framework every time, like, frankly, and maybe that's not the best answer, and maybe there's other folks that do it differently, but there's like kind of general things that we look to, right, in terms of deciding build by partner. But again, each instance is different. But like, so some examples though, maturity of the space. If you're buying into an area that is pretty mature, there's a lot of incumbents. If you're evaluating entering an area, regardless of build by partner, has a lot of incumbents, it's very mature. Building might has like issues, right? Building one, you have to learn a new competency that's already a space that people are very competent, right? It's mature space. People have a lot of subject matter and domain expertise. Trying to build from scratch, the other people who are already operating the space have a lot of battle scars and know-how that you don't have. Usually if something's mature, that means there's been a lot of investment that went into it. So probably the resource intensiveness of building from scratch may be high as well. Also, and then I think most importantly, timing. If a space is mature, business cycles move very quickly these days. Like the opportunity to execute against a certain vision, against like a certain TAM, can shrink pretty quickly. Businesses grow faster. There's information. It flows more quickly. Capital tends to be more available with the last maybe year or so, as an exception. And so, if you're tackling a space that has all these characteristics, again, you may lose the timing of the opportunity. It may just slip away. Like you may spend 2 to 3 years building into something that was maybe only a 5-year window of opportunity anyway. So maturity of the space matters a lot. And so often the more mature a space is, I think you tend to see the factors tip toward buying or partnering as opposed to building. Scarcity matters a lot. You may have a partner you're working with, but maybe they're really great and there's only a couple of them out there. And, frankly, if a competitor buys one of the other partners, like it puts your business at risk. If you're really reliant on that partner. And so, sure, again, you can like, just to take a step back in this specific case, I guess the point is, you may want to do what the partner is doing in-house, right? There might be economic value. You might be giving away too much value to the partner. You want to do it yourself. But in so doing, you may, one, hurt the partner relationship, but also two, if you risk somebody else maybe buying that partner, again, if they're scarce, right? If there aren't that many people that do what this partner does for you. And so that might point toward buying as well, right? Like, sure, you could build it, but if somebody else buys it, you put your business at risk. Like that's a fundamental issue, right? Like you have to kind of, again, look inwardly and say, how critical is this to my operations and my strategy? And if it goes away, what happens? Again, you have to kind of you have to understand the market and timing. Like maybe the partner doesn't want to sell. Maybe there's nobody else that actually relies on this partner. You may be its only customer. And so therefore there is no urgency in buying, but it's a factor. I think very special, like we're seeing this with AI now, right? Very specialized spaces where the talent is at a premium and the knowledge of, the subject matter is still new and there's a premium placed on the talent. Those tend to be areas you end up buying as well, as opposed to building. If I think it's hard. I actually would say I don't have like a great pulse on what the talent, what the talent acquisition space is like right now. But if you were to, I think look back the last 10 years, it's been hard. Like people do acqui-hires all the time, right? And why? Because there were certain engineers with specific domain expertise that were hard to hire and recruit. And so if your plan calls for bringing on 10 engineers with that expertise, and there's only a few thousand people in the world that do that, if you find an acquisition opportunity, and I don't love these, to be perfectly honest, but like if you find an acquisition opportunity to bring 10 of them on board at once, that seems compelling, right? Buying versus building. And so, and obviously a team that knows how to work together brings something special, that assembling a team, slowly over the course of a year by hiring 10 different engineers that never worked together, they just may not be as productive out the gate. And so, these are some of the factors. There's probably a whole nother laundry list of things. I think, sometimes you aren't sure, like the answer ends up being like 50-50. Hey, we could build this thing, right? And it's not so time of the essence that I need to give it to my customers the next year. I have time. But, if you never fund it, if you end up always saying I can build it, it keeps kind of going into your next year's priorities and you never fund it, it never makes it into your budget or plan. There's a real question there, right? Like, are you ceding ground to a potential competitor? Can somebody else come and do this and you will be a little late to the game, and then you may end up having to buy later on at a premium anyway, because time becomes of the essence. And so in those instances where it's a little bit 50-50, right? Like we could buy this now, we could wait 2 years. Sometimes we'll just kind of opportunistically talk to companies and meet them, and it doesn't happen often, but there might just be like there might just be a feeling, right? Like you meet and there's like a cultural meeting of the minds. You learn more about the business. If it's not something you're spending time on day to day as a product lead, as a deal sponsor, you can come to a view of the opportunity from the outside, but you don't know from the inside, somebody who thinks about it every single day for the last 5, 6, 7 years,
Mhm.
how they see the opportunity expanding over time. And so sometimes those
Mhm.
exploratory conversations, we do a lot of those where,
Mm.
there's not a very clear expectation on either side, but you get to know folks. Acquisitions sometimes take years to come together, but in terms of just knowing people and knowing, getting to know each other for a while. Um, but in those instances, I think you never know. You might spark some magic, and you might
Mhm.
feel like there's a there, and it's worth having the acquisition conversation earlier than later. Um, but but again, the deals take sometimes a long time to happen, and so I will very often, it'll be myself and somebody from the business, like a GM, that'll just kind of have a conversation with a company, a founder, and we'll just kind of keep it warm, right? Maybe check in a couple times a year. It's an area that we're interested in, but we're not sure yet whether we're going to build, buy, or wait on. The company itself isn't like in a rush to sell, but obviously they may have an idea of their 4 or 5 different landing places for the business when they are ready to sell. So having those conversations is actually an interesting kind of qualitative element of build by partner, where you kind of get to know the business and see if is this the type of business you want to be part of your company. So anyway, there's like a lot of factors that go into it. I think ultimately building, it's becoming easier often to build things, at least in the space I am, because APIs become available. As more people operate in the space, they build startups to service very niche needs. And so
Mhm.
there's a lot of vendors out there, so you don't have to build from scratch, and you can get things shipped a lot faster than having to build completely from scratch. And so there is like a bias, I'd say, at really good technology oriented companies, Silicon Valley companies, to build first. I think you just have to. It's my job to pressure test that. And yeah, sure, we can build it, but if we're going to take 2 years to build it, and our competitor is going to have it launched in 6 months, is there like? That's sometimes one of the bigger factors is time of the essence, because it's becoming easier to build a lot of things. Like it really is, just because of open
Mhm.
APIs and open protocols, and I think that trend's gonna continue happening. And so a lot of the weight on building versus buying, I think, and we'll see how it plays out, is going to come down to how important is timing.
Mm. I mean, it couldn't be any conversation if we don't talk about AI. It's 2024. Everything is about AI. So I wonder, when you were thinking about these, first of all, like when you were thinking about these mega trends. So like, last year, not last year, but like a year and a half ago or 2 year ago, it was crypto. Like everyone's talking about like how to, like all these like really hot crypto startups. And then now everybody's talking about AI. As someone on the corp dev team, I wonder, how do you think about these trends, companies like, you know, acquisition properties? Because I feel like you have to somewhat like buy low. Like you don't want to acquire them when they're like super hot. I wonder, like what is in your yearly agenda to spot these trends earlier, or like also like I wonder, like you mentioned, another really interesting part in the conversation was like the budget is kind of coming like, or like, for example, some product lead may tell you, hey, like we need to acquire this XYZ company, right? Or like people who are the sponsor within the company have to kind of come to you to be like, hey, come on, acquire this. Where does the budget come from? Does it come from that company, or like that department within the company, or does it come from like the M&A budget as whole? Like who
Yeah.
need to approve these things before it happens?
Want me to do the second question first? Because it seems it's a
Sure.
little easier. Yeah, sure. Uh, Two very different questions, Grace. I'll go with the second
Sorry,
one
I'm
first.
like my brain is just all over the place.
Yeah, all good, all good. Yeah, on the second one, again, every company is gonna be different for sure. Like, how do they use their balance sheet for M&A, whether it's cash or equity? We just call it both of those things, balance sheet. Um, and I think honestly, sector is going to matter too. There are some
Mhm,
companies, especially in more mature industries and like global conglomerates, who grow through acquisition. I
mhm,
look at I look at like a Booking, or I look at an IAC, and IAC is kind of like a whole different model altogether. But acquisitions are actually kind of kind of a product of in some ways. And so I haven't worked at either company. I can't profess to know for sure, but I wouldn't be surprised if there is like an allocated M&A, a very clear M&A budget.
mhm,
And I wouldn't be surprised if the CFO and the M&A team have more discretion in how they spend that,
Mhm.
because that's central to their strategy. Uh, where I am today, and like a number of the companies I've worked with, it's not that, you're relatively high growth businesses in and of their own right. And so the acquisitions are very opportunistic and furthering, like I said, a business need. And so we kind of look at them a little more ad hoc. Like for sure, there are earmarked. You kind of go through a process with treasury and your accounting teams and your finance teams to have some sense of earmarking, like what you think might be the cash you might spend on acquisitions over some period of time or a few years, what you think the equity needs will be. Each company has a usual cadence on which they acquire businesses. Like if you look at ours today, we acquire a couple businesses a year typically, and so you can have some level of visibility. But when you're doing it ad hoc, it's hard to set a budget for acquisitions because like just call it what it is. Like as a business, we acquired Afterpay a few years ago, right? And so
Mhm.
that was a massive acquisition, and so that and it was all equity, and so we didn't really set aside saying, oh, we will, we have 20% of or 30% of our equity available for acquisitions. Those are more ad hoc and opportunistic, and so that process. What we do is we create a framework on how do you risk balance sheet and how people can ask to risk balance sheet.
Mm.
How do we like think about ROI on acquisitions? Like what is our cost? We treasury keeps tabs on our cost of capital. Do we exceed that cost of capital in terms of the anticipated IRR? How confident we are in probability weighting different models and scenarios we built, um, and kind of looking at it from there's like I said, there's like a criterion framework around when we risk our balance sheet, like what hurdles are we exceeding, and we can make exceptions to the rule, but for the most part, like we're trying to, from an accountability measurability perspective, make sure that we are uh, complying with that framework. But it's ad hoc, and so the way the decisions are usually made again depends, right? Like, and each company has their own governance structure, but smaller deals typically, management team can often, like I guess, the C-suite can kind of make a decision on those. Each company has a criteria around when you have to go to the board for consent, depending on materiality of the deal. Depending on the size, but also not just the size, the strategy, right? Like if you're taking your business into like slightly new strategy, you may want to have proactive discussions with the board on it. I think that's probably best. Generally, you try to do that, right? It's best practice. But usually as a company with your corporate gov teams, you set thresholds, a materiality threshold based on, when you will go to your board, when you won't, when you can kind of do it async, when you won't. But typically, I've never worked in an environment where the CEO at least doesn't have a final sign off on. CEO and CFO don't have a final sign off.
Mhm.
I don't know that that exists anywhere. I think ultimately,
Mhm.
any acquisition, even if it's only two people and $10 million, it's still like a risking balance sheet outside of your existing plan. And so you have to
Mhm.
follow the framework on when you risk balance sheet, what's the criteria for IRR, and then probably get your CEO, CFO, and should get your CEO, CFO to sign off on it. And like I said, the more material ones, you'll also get your board to sign off on it.
Mm.
But it's iterative. It's iterative, just to be clear. Like especially the bigger ones, the more complex ones, or the ones that are a little more taking you into a new strategic direction. It's not like one board meeting and you're done, right? You'll have multiple ones, and sometimes as a board, you'll form a transaction committee, so that way you don't have to take up the whole board's time every time to discuss it. It's a smaller subset of the board you talk to, and then maybe take it to the broader board with the final recommendation. And we'll do these check-ins at different points in the deal process, right? We'll do it with the management team, with the C-suite for sure, right before we sign the term sheet, which are non-binding, and then before signing any definitive docs, go through the whole process I just kind of outlined.
Mm. How big is your team? And then, like, what do people do? Like, like, I mean, not what do people do? Like, I guess, like, there is, the people, I'm sure there's the people who is, like, doing a lot of, like, financial modeling, to kind of, like, calculate what is ROI. And by the way, how do you calculate the ROI? Because I feel like sometimes if it's aqua hair, obviously it's like, how much money are we saving from like hiring this team, like of engineer or whatever? So I wonder, like, so how do you structure your team based on this humongous scope of work? It's like, you identify what is a good target, or like you do some financial modeling on if this makes sense for us to acquire, right? And then the middle team would be like, I guess some people have to talk to the founder and like, gather information, and then after, like, and then there will be like a legal component, which is everybody have to evaluate, like, where should we give in, where should we like take, and then in the end there is like a bunch of people that are like integrating the team into the original company. That's how I categorize it based on our conversation. There's like, I feel like, four major criteria of things. I wonder, how does it like look like in real life?
Yeah. And by the way, my light's like fluctuating somehow, right? I don't know. Nothing's going on in my room, so I don't know
I
why it
think
looks like
you
a
look
strobe
great.
light. Okay, well, thanks. um, yeah, so the team today is we have 10 people on this team, but like everywhere's different. Like my corp dev scope, the team I ran at WeWork sat across investments as a separate vehicle, acquisitions and
Mhm.
partnerships, and so that was like 15 people. So it just depends. But on the team today, like we have like two functions, right? We have an integration team and we have a team of deal leads. The integration team's job is to start when we're past kind of like the deal evaluation uh, part phase of a deal, and we're past like the term sheet for sure. You start integration planning and like making sure we're ready for day one. Like for after we close, start getting ahead of some of the issues we expect post close that we have to deal with, from like employment related issues to like as simple as like making sure everybody has their benefits and can get paid on day one, to like tracking progress on if we have two different cloud providers, like we're going to probably consolidate those over time, and so like tracking progress there. Obviously the integration team doesn't do all these different things or different functions, but they project manage that, and it's super critical to whether or not you actually end up achieving the goals you set out for in the deal. The deal leads are the ones that are doing really, I'd say, like two or three things, right? Like one is on a deal itself. Yeah, all the financial analysis, thinking through, like you said, ROI, RRR, which I can get back to on acquihires in a second. Negotiating the deal, right? We have a separate M&A counsel team, and this is the case pretty much everywhere, that obviously will do the actual negotiation of legal docs. But they're your advisor. There's going to be commercial points of a deal, and there's going to be legal points of a deal. Commercial points will be like, how do you track net working capital, and what's the target you set? Obviously, the purchase price. There's certain components of the deal that are business terms, and certain that are legal, and so like the deal leads will negotiate those business terms.
Mhm.
They will, the project manage that piece of the acquisition, because as you're doing diligence, it's not just the business terms, right? You're diligencing accounting issues, things like legal issues I kind of shared, tax issues tend to be big, HR issues, and so they will project manage the deal evaluation part until it shifts into more of a integration planning exercise, and that's when there's a bit of a handoff. But like on the day to day when you're not working on a live deal leads are doing this. I mentioned all the strategic write ups, right? And so those write ups are a mix of a qualitative, like understanding what different companies are out there, and what they do and how they fit into a market map. Um, you know, Kind of standard VC or junior banker work. But they're also helping us market size and working with the finance teams to understand what the ultimate financial opportunity might be if we were to acquire something and monetize it, right? And so
Mhm.
um, they're sometimes they own the model, sometimes they're working with a finance team that maybe owns them or co-owns the model, but the valuation work is always done by those deal leads. As far as like ROI, like I think for a business that's generating revenue and cash flow, or not generating cash flow, but like has like a real P&L and L and product market fit and distribution and a business, pretty easy. I mean, I think the challenge becomes, any model's a model. You make a bunch of assumptions. You're modeling synergies. Yeah, you're doing your best at it. There's different ways to approach that. You can have like base cases, bull cases, downside cases. You can probability weight certain assumptions, and we'll do different things for different depending on the stage of the target. Are they super early in emerging space? Are they kind of more mature? We can kind of take depending on how predictable we believe the forecast is, we can take a different approach. And then also depending on how many synergies, like if we're trying to extract really new synergies like out of it, that
Mhm.
becomes more speculative. And so that also
Mhm.
informs the discount rate we use. But like for acquihires, you're right. And so anyway, that's pretty simple, right? Like ultimately, that's traditional corporate finance. You look at cash flows and you kind of look at the hurdle rate you've set, which is your cost of capital. Um, for acquihires, it's tougher for sure. We'll usually triangulate value across a few different ways, right? We'll look at um, you know value per FTE, like NGFTE, right? We'll look at roadmap acceleration, and that's really hard to peg. But how much by getting this product into market faster? Like how much do we pull in revenue and cash flow? We'll look at, to your point, hiring practices. Like, would we have used a search firm or recruiter and what would that have cost? Getting this person, well, thumbs up. So like
I want the thumb up. I don't know why Google reads my mind, but keep going. Sorry.
Great. So anyway, so I do agree. Acquihires are tougher. Uh,
Mhm.
and like, but so we'll usually triangulate value a few different ways. And it depends on the nature of the acquihire. Was it a distressed company, in which case we're just
Mhm.
trying to get some money back to the cap table to get the deal done, probably? Or
Mhm.
was it a company that has a lot of options and is really specialized engineers, and they're taking a very, even though they haven't really built a product that's in market and has like a real
Mhm.
P&L, what they're doing, but they have like a lot of potential and they have some really interesting IP, and that's if it's an acquihire like that, we have to do all this triangulation about like how would we place value on it. It's definitely more, I mean, every finance person in the world says this, but it's definitely more art than science in the acquihire space for
Mhm.
sure. And so it is definitely a challenge. But look, right now I think the tide has turned a little bit, and acquihire is a little bit out of vogue.
Mhm.
Other than maybe we'll see. I think the AI space, to your point, looks like it's going to be one of these domains with real specialized talent, and things that will have big price tags may actually be acquihires under the hood, given that
Mhm.
they don't have an actual business yet, but a lot of potential.
Mm. Hi, Rahul. Thank you for coming. And then, okay, so I just said hi to the audience. But anyway, so I have a question on, so like basically, okay, I want to save the last 3 minutes to your thoughts on AI. Are you, what's your
Yeah,
thought on like the AI acquisition space? And obviously everything
yeah,
is so overvalued. No offense to the like people who are working their AI startups, but I just feel like the AI valuation is like just irrational. And I know there's a lot of value creation in the space, but yeah, but still.
yeah. Like when I was at Samsung, we were looking at machine learning oriented businesses.
Mhm,
Samsung acquired Viv Labs, which was
mhm,
the former Siri founders and like a smart assistant. Um,
mhm,
we were looking at computer vision a lot as well for like some of the devices. So a lot of machine learning, and so even then there was like a premium on the talent. There wasn't really
mhm,
like I think it wasn't like you built a bunch of models, like what's
mhm,
proprietary, like what number of parameters in your model, like how much
mhm,
access do you have to GPUs. There wasn't really where we were yet, but there was a premium, right? Like, there were
mhm,
some acquirers paying like $10 million per
mhm,
PhD, right? And so if you had like 50 PhDs, that's pretty expensive
mhm,
business, right? And they probably hadn't really built anything other than create a lot of IP and R&D. I think we're probably, seems like in a space similar to that right now, where there's like clearly a scarcity value. It's not just the people now. I don't think it's just the PhDs. It's on how familiar folks are with models and their ability to create new models and like tackle use cases. And so, yeah, it's expensive. I look, from my perspective, AI is going to change a lot of different things. Like, when in the fintech space that we're in, I think customer service and onboarding, and how do you actually surface the right products at the right time? How do you make sure you're able to provide more touch to your customers, where historically you always needed a human centric model. I think it will change like the user experience. I think it'll increase engineering productivity. We're seeing that very clearly with like code completion, but it's going to go further than that. I think with AI helping with architecture and maybe bots that are doing optimizing your stack for you and refining your code base without you having to do much. So I think all those things are going to actually fundamentally change the way we work and the experience for our customers. From an acquisition standpoint, though, right now, yeah, it's expensive. A lot of the models are now open, and so there's like a lot of things you can do without buying. It's more about, I mean, in some ways, I see it kind of as a problem of who's familiar, like which engineers actually know how to navigate what's out there and bring it in house in the most effective way. It's less about the number of PhDs and building the models from scratch, because so much is available open. And so, um, I think the acquisition use cases from my perspective, unless you're a business that's like, unless you're like like a Databricks, unless you're a business that actually builds like infrastructure and the AI as part of like the engineering workflow is critical. If you're businesses like us, I think we'll embed AI into our products. But so much of it's open. It's more about understanding what the right use cases are. And I think what's going to happen is for us, it's maybe not super. Everything is kind of at a premium right now, and it's less about for us buying companies that repo models or are building the best models, and more about, I think, as the use cases play out, there will inevitably be companies that are leveraging AI, maybe not building models from scratch and maybe not having like the 50 PhDs on staff, but they're leveraging AI to tackle customer use cases that maybe they'll start making our M&A landscapes. But I think that's not where we are right this moment. It seems like we're probably still a year or two off from that, but who knows? It's moving fast. Hopefully you don't call me a hypocrite if a year from now we're buying a company that has AI all over its front page.
Yeah, I love that. On that note, thank you so much, Rohit, for joining us today. And where can we find you?
Where can you find me? Yeah, you can add me on LinkedIn's probably the easiest place, and then on Twitter I'm Mr. Rohit, which is I just a play on the fact that my last name sounds like a first name, and so a lot of times people think my first name is my last name, so Mr. Rohit.
Oh my God, I love that. Actually, yeah, okay, so your last name actually pronounced as Dave, right?
That's right.
Instead
But
of
yeah, as you can imagine, growing up, a lot of folks refer to my mom as Mrs. Rohit, and that would be very embarrassing for like an 8-year-old. But yeah, it's Dave. Yep, Rohit Dave it is.
Yeah, I love that. But anyway, thank you so much, Rohit, for joining us today.
Thanks so much, Grace. Yeah, happy as folks have questions or want to talk more about any of these topics, reach out to me on any of LinkedIn or Twitter or X, I guess it's called today, and happy to chat some more.
Please, stalk Mr. Rohit. But anyway, okay, stalk away, people. I will end the stream.
Thanks, Grace.